In this module, we will be understanding what mutual funds are, the terms involved, how to choose the most appropriate scheme according to our needs, and how to benefit the most from it. So let's get right into it. Mutual fund is a collective pool where investors can invest for collective benefits. Now let us first understand why mutual funds can sometimes be better than individual investing. First of all, a mutual fund is managed by a fund manager, and the respective individual is a professional expert in that particular domain. One can expect that most of the times the decisions taken by a fund manager will be on the correct side. Secondly, investing in mutual funds is very affordable. We can start investing with a minimum of 100 rupees, although the minimum investment amount can vary from scheme to scheme. Another advantage of mutual funds is the portfolio diversification. Portfolio diversification becomes very simple by investing in a mutual fund because you can simultaneously invest in different industries and also lower the risk comparatively. One of the biggest factors in mutual funds is the liquidity. Apart from the exit load, you can extract the invested amount easily in a couple of steps. Mutual funds are popularly categorized into equity, debt, hybrid, and a few other schemes. Equity schemes, as the name suggests, you invest in company shares. They are generally ideal for long term solutions. Typically, equity funds are known to generate better returns than term deposits or debt based funds. It has a certain risk involved since we'll be investing in the company shares. Debt based funds invest in securities which generate fixed incomes like treasury bills, corporate bonds, commercial papers, government securities, and many other money market instruments. It is considered to be less risky than the equity investments, and many investors with a low risk tolerance prefer buying in debt securities. However, they offer low returns as compared to equity investments, and it can be suitable for short term. Hybrid funds, as the name suggests, they are a combination of equity and debt investments, which are designed to meet the investment objective of the scheme. They are considered to be riskier than debt funds but safer than equity funds. They tend to offer better returns than debt funds and are preferred by many low risk investors. Open ended scheme. So they have virtually unlimited shares. An open end fund issues shares as long as buyers want them. It is always open for investments, hence the name open end fund. Open end funds are offered through a fund company that sells shares directly to investors. These schemes are highly liquid as buying and selling can be done anytime. Closed ended fund. So, in the closed ended fund, the fund company issues a fixed number of units at the time of launch. In simple words, a closed ended fund closes after the launch period until maturity. Once the NFO, meaning new fund offer, period ends, investors cannot purchase or sell units of that fund. However, they can be traded at the time of day when the market is open. They can't take on new capital once they have begun operating, and hence the name close ended scheme. Interval funds. Interval funds are a perfect mix of open ended and closed ended funds. These are unique funds which invest in illiquid assets and are ideal for investors looking for unconventional assets in their own portfolio. They also suit investors with short term financial goals and low to moderate risk tolerance investors. Investors can buy or sell units only during a predetermined period. Since you can redeem the units of an interval fund only during a specified time interval, they are highly illiquid in nature. Net asset value or the NAV. Net asset value represents a fund's per share market value. It is important since it helps us understand the value of one unit of that particular mutual fund scheme. It is calculated using the formula assets minus liabilities divided by the total number of outstanding shares. Ideally, one could say that a mutual fund scheme having a lower NAV would be better than a mutual fund scheme having a higher NAV because in a lower NAV mutual fund scheme, you will get more number of units for the same investment which you make in both these mutual fund schemes. AUM, or the assets under management. So, AUM is the total market value of the assets that are being managed by the particular mutual fund. AUM is an indicator of the size and the success of a given fund house. It is a crucial factor to consider if you are planning to invest in debt funds. There are a few investors which often look at the fund's AUM and get impressed if it's on the higher side. People think that if so many investors have already invested in this mutual fund, then it must be a good one. However, we cannot draw conclusions based on a single parameter, and we must look and compare the other parameters as well. Expense ratio. So, the expense ratio indicates how much the fund charges in terms of percentage annually to manage your investments. The expense ratio commonly varies between 0.1% to 2.5%. A mutual fund's expense ratio is very important to investors because the fund operating and management fees can have a large impact on the net profitability of the investors. The expense ratio is important because it informs you about how much you pay a fund house every year in terms of maintenance charges or the fund operating charges. A higher expense ratio for a particular mutual fund scheme can significantly eat into your long term returns or profits. Expense ratio also helps us in comparing different mutual fund schemes which have similar AUMs. Always remember, a good fund is the one that delivers good performance with optimal expenses. Exit load. So, the exit load is a fee charged by the mutual fund houses if investors exit a scheme either partially or fully within a certain period from the date of investment. The exit load value is a percentage of the net asset value of the mutual fund an investor holds. It is a vital factor for an investor to be aware of before investing. The intention behind the collection of this commission at the time investors exit the scheme is to discourage them from doing so. That is, to reduce the number of withdrawals by the investors from the schemes of these mutual funds. Different mutual fund houses charge different fees as an exit load. So to understand this better, let us take an example. Suppose a scheme charges 2% exit load for redemption within 365 days or 1 year from the date of purchase. Suppose you redeem 1000 units of a scheme 4 months after your date of purchase. Let us assume that the NAV is rupees 100. So the exit load will be 2% of the 1000 rupees into 100, which is equal to 2000. Every mutual fund scheme comes in two different versions, direct and the regular version. The difference between these two versions is that in case you are investing in a regular mutual fund scheme, you will have to do it via an agent or a broker, and hence commission charges come into the picture. In case of a direct mutual fund scheme, the traditional agent or a broker is not involved, and hence you avoid the commission charges. And as a result, you expect higher returns, have a lower expense ratio, and also can expect higher NAV. Therefore, I would always recommend you to go for direct plans because you will be in control of the mutual fund schemes you're investing in. Before investing in any mutual fund scheme, the investor always has to make a choice between growth and the dividend option. So let us understand how do they differ from each other. In case of the dividend option, the dividends you earn through the mutual fund scheme are not invested back into the scheme. They are deposited into your bank account. In case of the growth fund, the dividends are invested back into the scheme along with the original capital you had invested. So you may perceive the growth option like a cumulative option. You have to make a choice based on your personal financial goals and the need at that moment of time. Let us study some more basic terms. Lump sum. Lump sum is for a single transaction. It is usually used for one-time investing in mutual fund schemes. The minimum investment amount differs from scheme to scheme. SIP, or the Systematic Investment Plan. It is a popular investment method which allows you to invest periodically. The period can be daily, weekly, fortnightly, monthly, or even quarterly. It is very suitable as you can manage the market fluctuations very well. STP, or the Systematic Transfer Plan. It is again another investment strategy that allows transfer of funds from one scheme to another. SWP, or the Systematic Withdrawal Plan. It is the opposite of SIP. So the part of the investment capital can be redeemed in a systematic or a periodic manner. Again, the frequency can be weekly, fortnightly, monthly, quarterly as well. However, in this case, keep in mind the exit load and the taxation according to your own personal portfolio. DTP, or the Dividend Transfer Plan. It is a unique investment strategy in which dividend earned from one scheme is invested into another mutual fund scheme. So here I have listed down a few good practices which I think should be followed while investing in mutual fund schemes. First and foremost, the most important step involved in mutual fund investments is to choose the right mutual fund scheme according to your requirements. Next is to choose the appropriate investment strategy based on your portfolio and your income. Hold investments for a longer duration of time, minimum 3 to 5 years, because it yields better results. SIPs are always better than lump sum in case of long term investments because you're able to manage the market fluctuations well. Always review the scheme performance from time to time and make adjustments accordingly. I would always recommend you to go for direct plans over regular plans because you avoid the commission charges and hence have higher results and also higher NAVs. Always go for open ended plans over closed ended plans because you have the option of liquidity in front of you. Choosing the most appropriate mutual fund scheme based on your requirements is the most important step involved in investments in mutual funds. Now, I will be sharing my process which I have been following for choosing mutual fund schemes and adding them to my own portfolio. Choosing the most appropriate mutual fund scheme out of the wide variety of schemes available in the market is the most important step in mutual fund investing and is perhaps the most difficult one. I personally have been using Value Research website to compare the different mutual fund schemes available in the market, and this website helps me come to a conclusion as to which scheme is the most beneficial to me as per my own requirements. So under the funds section, once you scroll down, you can see a wide variety of different mutual fund schemes available based on different categories like equity, debt, hybrid, and commodities. Each of these categories are further divided based on either market capitalization or the objective of the scheme. Now, let's say, for example, I want to invest in a large cap mutual fund scheme. I simply click on this category and then you are directed to a new tab. Here you can see the list of wide variety of mutual fund schemes available in the large cap section. I always go for open-ended and direct plans. Let's filter out the lower rated mutual fund schemes first. Okay, so once we have filtered out the lower rated mutual fund schemes, the next step that I follow is comparing the net assets or the AUM. I simply click on net assets and arrange the mutual fund schemes in a descending order as per AUM. So here you can see that barring the first three, the following mutual fund schemes have a lower AUM as compared to the first three. So I'll exclude them from the final list of the schemes. The next parameter that I compare is of the expense ratio. In case of expense ratio, you can see that the first mutual fund scheme has a comparatively higher expense ratio as compared to the other two. So I'll exclude this as well. So only two remain, which is the Axis Blue Chip Direct Mutual Fund and the Mirai Asset Large Cap Direct Mutual Fund. So let's study the Axis Blue Chip Direct Mutual Fund. Okay, so here you can see or you can confirm that it's a direct plan and the equity is in the large cap. Here you can compare the performance for different years. Here you can see the change from the previous NAV. As you scroll down, you can see the various investment details like the minimum investment amount or the minimum SIP investment, the minimum withdrawal that can be done, and the minimum balance that should be maintained in the mutual fund scheme. You also get to know about the exit load if it exists. Here in this graph, you can compare the performance of the Axis Blue Chip Direct Mutual Fund to the S&P BSE 100. Different timelines are available and you can compare them as per your own convenience. Generally, if you choose a higher time frame, there's a trend that most of the mutual funds perform better than S&P BSE 100. As you scroll down, here you can see the peer comparison table. So we were comparing the two mutual funds which were Axis Blue Chip and the Mirai Asset Large Cap Mutual Fund. Here you can see that the 1 year return is 47.75 and 55.64. And in case of 5-year returns, Axis Blue Chip Direct Mutual Fund has 18.12 return and Mirai has 17.36. Scrolling further down, you can see the best and the worst performance of this particular mutual fund. Here you can see the asset allocation of this particular mutual fund. So in equity, 96.7% of the total amount is invested, and then the remaining amount is invested in debt and cash equity. As you scroll further down, you can see the sector allocation in the different sectors. Here you can get a brief understanding of how the mutual fund is investing its amount in the different sectors. On scrolling down, you can see the top holdings or the stocks this particular mutual fund scheme has invested in. Along with this, you can also see the percentage of assets that are invested in each and every particular stock. The upward arrow indicates that there is an increase in the investments made in this particular stock. The sideways arrow indicates that there is no particular increment or decrement in the investments made in this stock. And the downward arrow indicates that there is a decrease in the investments made in this stock. You can compare the portfolios of different mutual fund schemes and also at the same time draw some parallels with your own portfolio. Along with this, there is one important feature which is provided on this particular website. You can also understand the riskometer or the risk grade and the return grade for every mutual fund scheme and then compare it with your requirements. In addition to this, there is one important parameter that needs to be studied thoroughly. It is of the fund manager. A fund manager is very important in case of a mutual fund scheme because he or she will be making all the important decisions. You can study more on every fund manager either through the mutual fund website itself or on the value research website. So in case of Axis Blue Chip Fund, the fund manager is Shreyas Devalkar. So you can study more on each and every fund manager and understand whether that particular mutual fund scheme is stable or not. With this, I have shared my process of comparing different mutual fund schemes and selecting the one which is the most beneficial to me. I hope this video guides you in your journey of investing in mutual fund schemes as well. This is Nimish signing off.